So it has just been confirmed that Alibaba is going to issue $4.5 billion aggregate worth in principal amount of convertible senior notes and an additional $500 million for an options to purchase for existing bondholders. And these tranche of convertible bonds would be sold only to institutional investors. So right now, there are not much details that are being disclosed for this convertible bond. So we don't really know what's the strike price, whether there's a cap potential, etc., etc. I believe that the main motivation, at least based on this most recent convertible bond issuance, is that their cash pile, or at least their USD cash pile outside of China is slowly depleting, and you can understand more in the later part of this video. But I think the more interesting thing is that why only raise $5 billion? And why are you not doing it another way? Because the idea of a convertible bond would presumably dilute existing shareholders, especially if you think that the share price is currently extremely low.
Let's ask ourselves, what is a convertible bond? So if you to look at it from a business perspective, they tend to raise money via two ways or two means, via either debt or via equity. So via a debt instrument tend to be some sort of a bond-like structure. So I think as laymen's, we have our fair share in dealing with bond-like instruments. So long story short, a bond is basically an IOU. At the end of the tenor or at the end of the contract terms, you have a right to claim X amount of dollars, depending on the face value of the bond. And in return for holding this bond, in between, you tend to get some sort of an interest payment, or the more accurate term would be coupon payment. So a convertible bond is a bond that can potentially turn into a stock. That's why you derive the name a convertible. They basically act like any sort of regular corporate bond, where they promise you some sort of a coupon payment, whether is it annually, whether is it semi-annually, depending on the contract terms. But here comes the interesting thing about the convertible bond, which is the stock component. So this stock component is also predetermined when you first purchase that convertible bond. And it's written black and white in terms of how much you can convert, in terms of what's the strike price that you can convert, how many shares you can convert, etc., etc. So you might ask, why would someone be interested in a convertible bond? So the benefit is you actually get a fixed rate interest, meaning you get to enjoy that level of coupon rate or the interest payment. And there's also pretty much no downside risk unless the company, or in this case the corporate, default. So if Alibaba did issue this convertible bond, your only downside is when Alibaba goes bankrupt and they can't make good of the promise of this IOU or this bond. But the good thing about CB is that on top of this bond component, you get some sort of a call option where you participate in the stock price if it rallies, where we can look at the case study of JD.com later on. But the trade-off, you actually get a lower coupon or a lower interest for the optionality to convert this bond into a stock or into the equity position. So if you look into the JD.com case study, they've already issued this convertible senior notes at the aggregate of around 1.75 billion US dollars, and it's due 2029. And the promised interest rate is at 0.25% per year and payable semi-annually. So the conversion rate is actually 21.8 ADS, which is American Depository Share, per $1,000 in principal. And that's where you get your strike price. And in this case, it's around $45.70. So the conversion premium is around 35%. And how do we get this 35%? It's basically the existing share price when they issue this convertible note at $33, and you add a 35% premium, that's where you get a $45.70. So in this specific example, come 2029, let's assume that JD.com shares actually still trades below $45 per share. So what happens is basically they still have this IOU where they can claim back this $1,000 principal, and on top of that, receive that 0.25% in terms of coupon payment every single year from 2024 all the way to 2029. And if you're just a bondholder, this is essentially the best case scenario. You get back your principal, and on top of that, enjoy the coupon payment every single year, and in this case, semi-annually. However, for a convertible bond holder, this is not the best case scenario. The best case is actually if JD.com actually experienced some sort of a share rally over the next 5 years or so, and let's assume that it trades at $50 per share. And as you know, because the strike price is at $45 per share, so on top of the interest and coupon payment that you have received over the years, you actually get to enjoy another $5 per share, assuming that it trades at $50.70, times $21 divided by your principal. Let's say your debt is $10,000 in principal. So 10,000 divided by 1,000, that's 10. So you essentially can convert around 218 American depository shares of JD.com times $5. So that's your total upside, meaning you get the coupon payment and then you get to enjoy the upside as well. So for those of you who are looking to consolidate your investment holdings onto one platform, I think you are in luck. So right now, until the end of May 2024, Webull has a shares transfer-in campaign that allows both new and also existing users who have not transferred shares to Webull to get up to $150 in transfer out fee subsidy on top of cash vouchers, which can worth potentially up to $2,000, and exclusive $500 worth of trading vouchers. So you can qualify for this campaign by just transferring $10,000 worth of shares and maintaining it for 90 days to receive $400 worth of cash vouchers. And to get rewards from Webull's share transfer-in campaign, you just have to follow 3 simple steps. So step 1, go down to the link below, click on participate now, create an account if you haven't done so, and fill out the share transfer-in request in the app. So step 2, initiate a share transfer in before 31st of May and complete the transfer before the 5th of July. So once you complete the shares transfer in that meets the requirements, you can submit the transfer out fee proof to get the subsidy. And step number 3, meet the following requirements during the holding period and you can get to claim the rewards from the My Rewards page during the stipulated time. So it's as simple as that. Don't waste any more time. You can sign up for a Webull account in the link down below and enjoy all the perks today. Why would a company want to use a convertible bond? I think there's 2 main reasons here. Number 1, as you can see, in terms of the JD case study, the interest or the coupon in this case is 0.25% per year. And this is egregiously low compared to the US Treasury. And I would reckon that the US government is much more credit-worthy compared to JD.com. So I think the idea of why someone that is even remotely interested in such an instrument trying to have a capital protection on the downside, because let's assume that if JD.com really not perform in the next 5 years, your capital is protected. Yet at the same time, you have this so-called call option with the strike of $45.70. And any outperformance will yield you a great amount of returns. So this is the first reason. It lowers the coupon rate on the debt. And in this case, lowering the interest expense from a company perspective. And the second main reason, it essentially delays dilution. And for companies that actually prefer to issue debt security in the medium term, because interest expense is actually tax deductible. But long story short, if you expect the share price to appreciate significantly, well past over this strike price, then there will be a level of dilution to existing stockholders. Now, I think here's the main point of contention. The biggest question for most Alibaba investors today is, why does Alibaba even need to raise capital via a convertible bond program? And if you just observe the balance sheet, this is the asset profile of Alibaba today. In terms of current assets, cash and cash equivalent, $34 billion, short-term investments, $36.4 billion, current bank borrowings, $1.7 billion, current unsecured senior notes, $2.2 billion. Non-current bank borrowings, $7.7 billion. Non-current unsecured senior notes, $11.9 billion. And if you combine them together, Alibaba even disclosed themselves in the presentation that their net cash position is at a whopping $61.8 billion. And just the last quarter alone, they spent around $4.8 billion to repurchase outstanding shares to basically benefit shareholders. And right now, you're telling me, based on the headlines, Alibaba is going to issue a $5 billion convertible. How does that even make sense? Now, there is a plausible explanation. So 2 quarters ago, in one of the earnings call, when a Barclays analyst actually proposed the question, so it's great that you increased the buyback by 25 billion. But in terms of the pace of the buyback, we understand there are constraints and limitations such as capital control. So could you talk about the sort of the cash you may already have outside of China? And this was Toby's reply, who's the CFO of Alibaba. So a certain percentage of that cash actually is sitting offshore, which we can use to do the buyback. On the other hand, we can also further leverage either to make investments in our offshore businesses, as well as using those sort of cash to do the buyback. And we can use it if we need it. We can increase the leverage also to sort of get sufficient cash for us to do the share buyback. And we are targeting to reduce the share count of at least 3% every year in the next 3 fiscal years. So I think the short answer would be, maybe the cash on their balance sheet, the $60 over billion USD, you can see it, but you can't touch it. So that's why they need to leverage up their balance sheet to basically buy back shares and to issue out dividend. Because the 60 over billion, it's probably the piggy bank of the CCP. And that's probably one of the biggest reason why investors are currently skeptical of whether this is even belonging to Alibaba in the first place. Even though it's parked in their balance sheet, if you can't use it, it's technically not even your cash. But here's my major pushback. Just recently, Fang Xinghai, who's the vice chairman of the CSRC, which is the China Securities Regulatory Commission, said that the government set out policies last month to basically strengthen capital markets. And it includes move to encourage listed companies to pay more dividends. So Chinese listed companies traditionally have not paid enough dividends. We are now encouraging them to pay more dividends. And this should very much enhance investor value of Chinese stocks moving forward. So it doesn't seem to me like the Chinese government is essentially restricting these companies from issuing out dividends or even buying back shares. Yes, there might be some sort of a capital constraint or capital control. They can't flow out the money immediately and to just wipe out, 30% of the market capitalization. But it doesn't feel to me that it was an outright restriction.
So all things considered, I can probably understand why the management team wish to do something like a convertible bond rather than issue out a plain vanilla corporate bond that pegs itself to the US Treasury plus a certain premium, especially so in this elevated interest rate environment. However, I think there is a few inevitable questions that pop up. Firstly, I think this 5 billion bond issuance is not going to move the needle. 5 billion on a $200 billion market cap, it's 2%, 2.5%, and they have already announced a very huge share buyback program. And just last quarter alone, they have already retired $4.9 billion worth of shares. So at this rate or at this trajectory, 5 billion, they'll use it up in no time if they are able to raise it with the institutional funds. So that's first point. Second point, I think it goes back down or it boils back down to this so-called China risk. And many investors that are casting aspersions, they are worried that this $60 billion cash pile, net cash pile on Alibaba's balance sheet today, I think when push comes to shove, are they really able to tap onto this sum of money? Or is it really just a piggy bank for China and Alibaba is unable to move it out? I think it's fairly interesting because I think now there really isn't a need for this cash, but maybe in times of crisis, if the money is still locked up and Alibaba is unable to deploy this cash, then really it's not accrual to shareholder. And that's why it's a can of worms that a management team has to kind of provide more clarity. And it seems like at least in the previous earnings or 2 earnings call ago, there was not much clarity. And that's why people are getting jittery and people are, I guess, not very hopeful and inspired by this new development. So as for my personal read, this is actually not the first time that Alibaba does something like that. I think the previous round that they raised some sort of a bond issuance was back in 2021. And to be frank, when I look at this development, it seems like issuing out some sort of a bond and raising capital in the foreign jurisdiction is kind of the expedient way or the quick way for them to raise US dollars. If not, I do believe that they have access to the 60 billion, but they probably have to jump through some sort of a hoops. There might be some declaration and stuff like that, which makes it, I guess, not very convenient. And that's why they didn't decide to just convert out the money. That's just my perspective. Feel free to leave in the comment section down below if you don't agree. And yeah, I'll see you guys in the next video.